Good evening, everyone. Hope you're all well, keeping well. Today we're going to be talking about a very important part of financial planning. Mind you, everything is important in financial planning, but life assurance and the need for protection. We're going to be covering various topics about life assurance and some of the things that people are aware of, but not always aware of the nitty-gritty. And we hope to answer some of those questions for you. Prabhavan, could you slide, please? Next one. So today we're looking at the life cover, what it is, and different types of covers available. And again, we've got three more areas this period, making most of your personal allowances, pension options at retirement, and inheritance tax planning. That will be coming soon as per those dates. Next slide, please. So like we said, we were designed these sessions really to help people answer those questions that they need to ask themselves or their advisor, and get some professional help, or just look at what they've got. And this is very much an overview. You can only cover so much in the half an hour, 35 minutes that we have. We'll take some questions at the end, and we've had a number of questions which we've answered via the email. And again, we've had really good feedback from people on the fact that they're enjoying some of the topics and also finding out things that they didn't know. So next slide, please. So yeah, feedback again, as I said, previous sessions, we've had various feedbacks. Again, if you want any particular things answered, please feel free to ask them. Our email address is oshwalweb@oshwal.org. Feel free to ask any questions. We'll try, and Vinay and myself will try and answer those questions for you. So I'm just going to hand over to Vinay, and he'll take the next couple of slides.
Thank you, Paresh. Jai Janendra, everyone, and welcome to the next in a series of webinars, as Paresh has already mentioned. So just wanted to talk to you about what is life insurance. So there is a legal definition of what life insurance is. Life insurance is a contract between a policy owner and insurer, where the latter agrees to reimburse the occurrence of an insured individual's death or other events such as a terminal illness or a critical illness. The insured in turn agrees to pay the cost in terms of insurance premiums for that service. So that's the legal definition of what life insurance is. To simplify it a little bit, next slide, please. So in simple language, life insurance is a financial product that enables you to leave money behind for your family when you die. This can be used to support them for several years, to replace lost income or to pay off a large debt like a mortgage, and you pay a monthly premium usually for this type of insurance. Next slide, please. So as you can see, there are many different types of protection and life insurance out there. We're going to take each one in turn and explain to you what each one means. But in simple terms, they all do different things. Some of them provide you with lump sums, some of them provide you with an income, and some of them pay expenses. So they all have they all provide different types of benefits for the person who takes these insurances out. Next slide, please, and hand back to Paresh.
Thanks, Vinay. So those terms that Vinay just put up on the slides, I'll just go through them in a little bit more detail. Term assurance, what does term assurance do? Is basically it covers you for a period of time. So if you've got a a risk that you want to cover, maybe 5 years, 10 years, 25 years. It could be a mortgage. It could be something that you think, well, your children are young at the moment. You'll need life cover for the next 20 years until they're financially independent. So you provide for cover for that period. And, work. So after that, it's a bit like car insurance. If you don't claim, you don't get anything. You paid your premium, and the money is the risk that the insurance company take and give you that cover. There's no cash value at the end of the day. There were some old style plans that have those, but they're very bad. Were used to be a very bad value for money, so you don't see them that much now. Whole of life, it does what it says on the tin. Effectively, it covers you for the whole of your life. As long as you keep paying the premiums, you're covered for the cover. So you may want to cover it for inheritance tax purposes. You may use whole of life to cover that. Premiums tend to be a bit higher than term assurance because it is covering for the whole of life. Next one is income protection, providing you income in case of ill health. It could be that you've definition could be a broken leg, so you can't carry out your work or your duties. Could be that you've got long-term illness. It will pay out income until you're retired or a particular age, maybe 60 or 65, depending on the terms of the policy. And you pay a monthly premium for that, and it will cover you up to a certain amount of your income. You can have this cover can start from 4 weeks of continued illness, or 3 months or a year, depending on your needs. We always say that people will have some money to last them if they're not working or not have no income for a period of time. But this one will be they can have it started from 3 months' time, so they'll use up their cash reserves, and then 3 months' time, this will start to pay you income. Next slide, please. Often people mistake critical illness and income protection. So income protection provides you a monthly income until you retire. Critical illness, in the main, provides you with a lump sum benefit on a diagnosis of a serious illness. And the major illnesses which we're all aware of, it could be cancer, stroke, heart attack, paralysis, any of those illnesses or more. There are lots of conditions. I'm not going to be able to cover all of those, but there's a huge range of illnesses a life policy can cover, a critical illness policy can cover. And again, this tends to be for a period of time, not for whole of life. It covers maybe up to age 65, 70, depending on the provider. And you can claim, so if you had a heart attack, it pays out, and after that, it will policy will expire. So you're able to come back to work, and you've had a benefit of a payment just to help you through that period of illness and pay off bills and live a slightly more comfortable life. Family income benefit is rather unknown to most people, but it's quite an effective and a cost-effective way of providing cover for your needs. So, for instance, if you've got children and you know you're going to need, I don't know, let's say £5,000 a month income to cover your costs, you can provide that for until they're 18. So it will last for 20 years. If you're not there tomorrow, they will pay £5,000 out a month until 20 years are up. So it's a fairly cheap way of providing cover for a certain amount of benefits. You can have critical illness in there as well. Medical cover, I think most people are aware that it's for you to be able to get treatment quicker or get private treatment for any illnesses that you're not able to get through the NHS as quickly as you'd like, or it will pay some money if you're ill as a cash plan. So you've got medical insurance, which will pay directly to the hospital, or some will pay cash. So for instance, you've got dental cover, they will pay you £200 a year for any dental treatment that you may have. So I think you're handing over to Vinay now.
So just to cover off, when you're looking at premiums, there are two different types of premiums that are payable. reviewable premium or fixed premium. So depending on which type of insurance you take out, you'll be dependent as to which premium type you pay. So reviewable premiums are usually ones that review either on a yearly basis or every 5 years or a set period of time. So they usually are cheaper to start with because obviously the premiums will start going up over time, and they become more and more expensive as time goes on. And therefore, sometimes what happens at a point in time when they reviewed the premium many, many times and the premiums have become so expensive, people naturally will cancel that cover, which is obviously not the way to look at insurance and not the right thing to do. So you've got to be careful when you're looking at these types of insurances. Make sure that you understand whether it's reviewable or fixed. Fixed premiums is the preferred method because with this type of premium, the premiums you pay are fixed for the term of the policy. So therefore you have a surety, or you have some assurance that basically the premiums will not go and get more and more expensive as time goes on. They stay the same throughout the period of your cover. But naturally they can be more expensive to start with than reviewable premiums. But there will come a time when they'll become, reviewable premiums will become more expensive than fixed premiums. So it is a case of making sure you choose the right ones and not going for the cheapest cover without understanding what would happen with those premiums in the longer run. Next slide, please. So a lot of the times, I'm sure Paresh is also agreeing with me on this one, we get asked a lot of the times, when's the best time to take out cover? Now, there isn't a real specific time that people should take out cover. We would say that basically you take out cover as and when you need it. So for example, if you have a mortgage, you take out a liability or a debt or something of that nature, then it's always a good idea to take out insurance to make sure that in case of something happening, whether it's an illness or whether you pass away, that the mortgage is paid. It's usually better to insure yourself when you're younger and probably healthier. As time goes on, naturally, a lot of people will get health conditions, like diabetes, high blood pressure. These are sort of things which will make the premiums more expensive if you take out insurance later on. So it's always a good idea to take out the insurances the younger and the fitter you are. And as I say just there, so when you have no medical conditions is obviously the ideal time to take out insurance. As premiums are also based on age. So again, when we say you should take out insurance when you're younger is for that reason, because if you think about it, as you get older, naturally the risk of something happening gets greater, and therefore the insurance that you take out becomes more expensive as you go along. So it's always best, as we said again and again, that you get a premium when you're younger, and that premium, as we mentioned earlier, if you do the right type of insurance, which is to take it on a fixed premium basis, you can then make sure that that premium stays the same for a really lengthy time. And some of these term assurances can take the cover all the way up to age 90. So we're not saying the whole of life. They won't cover you for all of your life if you're lucky enough maybe to live longer than 90. But it gives you a very good term for someone maybe in their 30s or 40s to know that they can take out insurance which will last for 30, 40, 50 years ahead. Next slide, please. So just to give you some idea of costs, obviously these are based on certain ages, and so the premiums will be different for different people, and premiums do tend to vary as time goes on. So this is just to give you some idea. We would always suggest that you take out critical illness before you take out life insurance. The reason for that is critical illness insurance is the more expensive of the two, because if you think about it, life insurance is one of those things which is becoming cheaper and cheaper as people are living longer and longer, whether through medication, whether through long-term looking after yourself, or whatever the reason is. Life insurance tends to be cheaper than critical illness insurance. And with time, because now more and more people are making claims on critical illness insurance, the premiums are getting more and more expensive as time goes on. So therefore, we would always say that you fix the premium at a younger age, and at least you have you have no hassle later on in terms of the premiums being increased on you. So to give you an idea, for someone to take out a life critical illness insurance for £250,000 to the age of 75, someone who's age 30, the cheapest premium is about £103 per month. And if you compare that with someone who's at age 40, total premiums you pay over that period of time, £196 times by the term, is £80,000. So you can see there's a big difference with the amount of premiums you pay depending on when you take your insurance out. Next slide, please. And this is just to show you the difference in premiums, that if you took out an insurance that covers you just for death only, then the same person at age 30 would pay a premium of £14.86, and at age 40, £26.60. And you can see there's a vast difference even there of 7,800 as compared to 10,800. But the difference is mainly in the critical illness premiums that we saw earlier. I'll hand back to Paresh.
Thanks, Vinay. Yeah, it is quite startling, the cost of life insurance, cost of delay. There are various ways to take out life insurance. Single life, i.e., it's one person insuring their life, or which is if that person dies, they will his family or her family would receive a lump sum. Joint life is, as it says, it's for a joint life. So it could be joint life, husband and wife, anybody really, two people are buying life insurance because they've got some insurable interest, either because they're insuring a mortgage, they bought a property jointly, and they want to take up some life cover just in case one of them passes away, the mortgage is paid off, and the other one isn't left with the debt they may not be able to cover. So that's joint life. Joint life first death. This is the most common type of insurance. So if you're taking out joint life term insurance or whole of life, joint life first death, which is if the first person dies, it pays out. Joint life second death. This is something that is common when you're doing inheritance tax planning. It would pay out on the second death. So if in the case of husband and wife, usually the assets pass to one or the other. The second person to die will crystallize that life insurance benefit, which is usually put in trust. We'll talk about that in a minute. Put in trust, so it is used to pay the potential inheritance tax that the estate of the deceased has. So just to cover that again, husband or wife, husband passes away, the estate normally passes to the wife free of tax. After that, on the passing of the wife, the estate would pass to the beneficiaries, normally children, and children would potentially have a tax liability. And this joint life second death, usually put in trust, would pay out a lump sum, usually to cover the inheritance tax. So next slide. Why do we need life cover? So normal reason why people take out life cover is to pay off a debt in case they pass away suddenly. And usually, again, the other thing is to provide for families' needs. If they're the breadwinner in the family, they need some income. The family will, life insurance would pay a lump sum to sustain the family until they're independent, financially independent. And as I covered earlier, use of life cover again is to pay inheritance tax bill, potential inheritance tax bill. So joint life second death is where this is the way it's used. Again, it could be just that somebody wants to make sure that the children are financially better off than they were, and provide life cover so that after everything they've got something to give them a good start, a good financial future. So that's the kind of uses of life cover, which I think I've covered over a previous slide as well. How much cover? Sorry, next slide. Before I go on, I think one of the things that Vinay mentioned about is cost of life cover. One of the alarming statistics is that people pay more for their pet insurance than they do to cover their own life, which is quite alarming. We will insure our car, insure our pets, but we won't insure ourselves. So something that we should think about. Amount of cover. How much do we need? Well, it depends on what your budgets are, what your financial circumstances are, but we always say provide some cover. Provide some cover, at least to cover your debts. And also, if you have the budget and the financial capability to provide cover, and if you put this, if it's set up correctly, it can be outside of any inheritance tax as well. So it's really a good way of potentially provide for your loved ones after you're not around. So again, it could be that we talked about family income benefit, a fixed amount of money coming in each month until the children are financially independent. And you could sit, whether it's 2,000 a month, 3,000 a month, you can work that out with a financial advisor. And as we always keep saying, always speak to an expert. There are lots of things that you can do on the internet and choose the cheapest provider, but that doesn't necessarily mean you're getting the right cover. One of the things I just wanted to cover off is that when we do joint life cover, now sometimes we just don't do joint life. We do four sets of covers effectively, 2 critical illness, 2 life covers. And it doesn't really cost more than just a few pounds more than doing a joint life cover. Because joint life cover is one person died, the whole policy is cancelled. Whereas if you have 4 policies, which is 2 life cover, 2 critical illness cover, for a few pounds extra, if one person dies, the other one still has some cover. And suppose your children are young, and you may still need financial cover for them because you may not be around to provide for them later on. So it is always worth talking to an advisor before you do any kind of cover. Now, putting policy into trust. Next slide. Sorry. Putting policy into trust. So this is to ensure that the people who you want to get the benefit of the life assurance policy get that, and outside of the inheritance tax. So if the policy is put in trust, it goes to, let's say, your children will get it free of tax or free of inheritance tax. And this is where we talked about the whole of life policy, joint life second death, where you would get proceeds going to trust, used to pay off any inheritance tax liability. If there isn't any inheritance tax, the children or the beneficiaries would get the benefit without any tax liability. Trust, when you're buying a life insurance policy from any provider, they will be able to put that policy in trust for you. There is no cost associated with that. So if the circumstances are right, and you would like to put that policy into trust, you can put it in trust. It's not suitable for every circumstances, but again, seek advice, and this is where you will be able to clarify whether you need to put that policy in trust or not. But it's really important that you do talk to somebody and think about putting the policy in trust. Over to you, Vinay.
Thanks. So before we go on to the next slide, I just wanted to say that what I found, and I'm sure Paresh has seen the same, is that people put these take out policies, but they don't necessarily put them into trust, and it's a step that's often missed, and it can be quite detrimental if it's missed. And sometimes putting a policy into trust, although it is free, the paperwork and the documentation that you need to complete can be quite complicated. And as Paresh has said earlier, it's always a good idea to seek advice from someone suitable who can help you through those forms, because to get it wrong can also lead to detriment in other ways. So just to bear that in mind. Next slide, please. So relevant life. So relevant life is a type of insurance which a lot of people, to be quite honest, have never heard of before, and is a very underutilized cover, but a very, very substantially good cover to have. So this is where a life cover can be provided by an employer for the benefit of an employee, or including like directors of a limited company. This is where it works really well, where you have people who own their own companies and are looking to take out insurance. The insurance can actually be taken out through the limited company. And the great thing is that the premiums will be paid by the company and therefore treated as an expense to the company rather than to yourself. So if you think about it, when you earn money and you get income from a company, or whether you get it from a salary, it's taxed. You've got national insurance, you've got all those other deductions that are taken away from you. And then you buy life insurance and the premium comes out of your net income. With this, the premiums come out of a business account and therefore act as an expense to the company, and therefore has the benefit of reducing your corporation tax liabilities. And therefore you save money because you're not paying tax, income tax, and national insurance and things like that on that money. So basically, the cover would be paid to the named beneficiary of the life assured. So basically, it doesn't get paid to the company that's taken out the cover. You basically fill in a trust form, and say, for example, you work for yourself. You can, as a person, you can take out the insurance and put in trust for your spouse or for your children, and it will just pay out to those people on death. So it's a very, very good tax efficient way of insuring. And because of the fact that it is a very tax efficient and good way of insuring, there is a limit to the age to which you can take out cover in this format. Because imagine the situation is most people retire and companies close down. So therefore the revenue has taken the option to say that, look, you're not going to need cover beyond age 75, because not many people tend to work beyond age 75. The amount of cover you can take out is also limited to a multiple of your income, which is typically 20 to 25%, 20 to 25 times your income, basically paid through the company. So it can be quite a substantial amount. If, for example, you earn, say, £50,000 a year, 20 times, you're talking £1 million of cover. So it can be quite substantial from that point of view. It's not to say that that's the amount you need to take out. You can take out less, but its maximum is a multiple of your income. And the other thing is also, a lot of people ask us the question whether or not this counts as a benefit in kind. So it's not a benefit in kind, and it's not something you need to declare on your P11D. And again, it's the insurance and everything else is outside your estate if it's put in trust as well. The other good thing about this is that sometimes people leave one company and go and work for another company. And the great thing is you can actually then start paying those premiums yourself if you want to. Premiums don't change, or you can transfer it to another company and the premiums will then be paid from that company as well. So there's great opportunities to keep that insurance going, because sometimes people do leave companies, don't stay with the same company forever, or you may close down a company earlier than expected. You don't need to lose the insurance, because ultimately otherwise you need to take out a new cover, which could be expensive, as you mentioned, again, because of health, because of age, and other sort of factors like that. So just bear that in mind. It is an insurance that is, as I say, very underutilized, and something sadly a lot of people don't know about. But for the right people in the right circumstances, it can be a very great benefit to have. Next slide, please. So that really concludes the sort of formal part of our talk today. Again, just to mention some resources if you want to find out some more details on all different financial topics, not just life cover and protection. Money Advice Service is a government website, moneyadviceservice.org.uk. Money Matters Made Simple is another site, and choices.sjp.co.uk. There are plenty of resources out there. You can certainly do a lot of investigation and reading to just make sure you understand things, in a simplified format. And then, I would always suggest that before you take any sort of insurances out, always be careful of what you're taking out and be sure you know what you're taking out. So just one last thing I wanted to just say, which is basically, a lot of people go online with the meerkat.com and all the other type of insurers out there. Just be mindful that they are just going to quote you the cheapest premium, and they're not necessarily the best insurance or the cover that you should take out. So just be mindful that it's not always best to take out the cheapest option. Just be very aware that you understand what it is you're insuring for, and then take a decision based on that. Next slide, please. So to summarize, protection is obviously a very important part of planning, and we would say it's probably a bedrock of all types of planning that we do. Ultimately, everything you do, whether it's a pension, whether it's an investment, whether it's some sort of other investments, if you were to pass away suddenly, then everything else is at risk. And so we would always say that protection should form the bedrock, as I mentioned, or the foundation of any sort of financial plan, to just make sure that everything's taken care of for the future. We would also say that review your options regularly, because whatever was right at the time is not necessarily right today. People's circumstances change. The need for cover changes. Your mortgage amount might be more, might be less later on. The term of the insurance required could be longer than you've got left on your insurance. So it's always good to keep these things regularly reviewed. And I would always say that a lot of people sometimes come to us and say, I want to take out cover, but it's just too expensive. And I get that. Not everyone's fortunate enough to have a budget that can support all of these type of insurances and all the types of things that we can do for people. But something is better than nothing. So what I'm trying to say is figure out a budget, but don't do something, but don't do anything is not a great option. Always say to yourself, if something is better than nothing, and make a decision based on that. Always put some money aside for this area of need. Paresh, anything you wanted to add?
Just I think just echo what you've said. I think I had somebody ask the question that the cost of term assurance, and if it's above this, I don't want to buy it. I'll just put it away in a savings plan. Now, you kind of illustrated the costs earlier of buying when you're 30. So just quickly look at the slide here. So term assurance for 30-year-old for 250 is £14.86. And that over a period of time, you will have paid £7,800. Now, when you think about what the benefit could be to your family, not sure that putting that money away into a savings plan, even if you put money away into a savings plan for the next 10 years, it's not going to amount to much. It's probably £180 a year and £1,800 over 10 years. And if you die within that period, one, there's not going to be anybody putting money into that savings plan, and two, your family don't have any lump sum to make their life easier. So it is vital, and I'm like I said earlier, not maybe in the Indian community, but people will insure their pets more than they will do their life. And I know the cost of pet insurance. We have a little dog, so I know what the cost is. So people should think about this more and more. And don't forget, most employers will provide a death in service benefit. And Vinay mentioned about relevant life cover. The relevant life cover was to kind of help. Small companies can't afford to set up those death in service schemes. So this was one way revenue allowed to set up your own death in service benefit. If you own a small company, whether you're partnership, limited, sole trader, it doesn't matter. You can put that in place. And I think seek advice is and keep reviewing your policy. And final thing I want to say is make sure your family are aware of what you've got. A lot of the time they don't know what you've got, and so I've seen people, clients, where you go and see them, they've got policies that, hey, they don't know what it's doing, and sometimes you may be overpaying. You may not need the cover. Would you agree, Vinay?
Yeah, definitely. There's always, as I say, come back to reviewing it on a regular basis and making sure you have the right cover for the right things in place. Overpaying premiums is something that you see. The other one thing I wanted to add to that is ultimately when you take out all these insurances, you want to make sure that they're going to pay out as well. So the claims process is pretty straightforward. Most insurance companies are pretty good at this sort of thing. It's a very simple process from that perspective. So just to assure people that, you do all this work and make all the right sort of decisions, and then it comes to the point of claim, then some people get very nervous or fearful. Are we going to get, is it going to pay out and everything else? To be quite honest, unless you've not disclosed any sort of information, then most of the insurance companies are usually pretty good at that. So yeah, I would suggest that just keep that in mind as well.
And I think also the point again about cheapest isn't always the best. It applies really more so in the critical illness cases. The cheapest cover may not provide you the cover that you want, you need. That's look at the cover it provides. What kind of illnesses does it cover, and what will it pay out? And small differences can make a huge difference. If it doesn't pay out, well, you've wasted your money. And the fact the value for money, is in the advice as well as the cover that you're getting. And make sure when you are completing that form, you disclose everything that you know of. And there are times when we've done the proposal for a life insurance application, we go to the doctors, and suddenly there's a whole ream of things that the client hasn't told us. And yes, you will get lower rated, but it's better to get rated and that premium policy pays out than not pay out because of non-disclosure. It's vital that you do that. I think we've covered everything, Vinay. Just some questions.
Yeah, there's a question here from Hava. Is there a savings policy with profits or unit linked for 10, 30 years where the proceeds are tax-free?
How about that? I think those used to be around, as I mentioned at the beginning of the session. They're not good value for money, so they're no longer as popular. I'm sure there are some. I'm not aware of any. But the ideal way of doing this is to put money into an ISA regularly, which is, again, unit trust. Don't think there are any with profits ISAs. I'm not sure, but I'm not aware of any. With profits isn't as popular as it used to be, because it's not as transparent as unit trust. So I would say look at ISAs, put money away regularly, and that will give you that same result as a policy used to do. Next one for you, Vinay. Paresh mentioned that life assurance cover can minimize IHT liability if it's set up in the right way. Can you give an example of how this can be done?
Yeah, so if you remember from previous webinars that we've said that inheritance tax is payable on traditionally any assets that you have which are worth over about £1 million. So if you have an estate that's worth 1.5 million, for argument's sake, then the first £1 million, if it's in property and your personal assets, is usually free of inheritance tax. The 500,000, however, is chargeable at 40% inheritance tax on the second death. So you're talking about a £200,000 liability. So we would always say that insure the £200,000 liability. But as with everything else, as investments and as property prices keep continuing to increase, your inheritance tax liability potentially could also increase. So we would always say maybe rather than taking a fixed level of cover, take something that goes up in line with some indexation like our retail price index or something like that, to just make sure that there's enough insurance wherever possible. And it's done on a whole of life basis naturally, because unfortunately we don't all know when we're going to die. And we need to be certain that if we take out the insurance, that it will pay out at some time in the future. So just be mindful of that. I hope that answers your question. There's another one here from Nidhi Shah. What are the benefits of putting policies into trust?
So putting the policy into trust, ideally, what it means is that on death, effectively, the proceeds of that policy go into a trust and would be outside of the inheritance tax, for one. Second, it also can go to the desired beneficiaries directly and quicker than it would do otherwise. So if the policy wasn't put into trust and somebody passes away, it stays within the estate and becomes taxable, potentially taxable. And also, it may not go to the beneficiaries it's intended for. So, for instance, somebody said, look, I want to make sure that when I pass away, I leave 100,000 to my daughter. And so you put that in trust for the daughter. So on death, she gets 100,000 much quicker, doesn't have to go to probate. So it's a much quicker, much efficient and tax efficient way of putting a life policy into trust. Nidhi, I hope that answers your question. Nita's asked, can you take out life assurance policy for somebody who is 80 years old, and would it be expensive?
Yeah, so I suppose, Nita, the questions are, as I mentioned earlier, the younger you are, the cheaper it is. So in your 80s, obviously the insurance cover is going to be quite expensive. And the other thing is that maybe the person who is in their 80s may have other health conditions in the background, which will obviously mean that the premiums will be quite expensive in a traditional sense. However, there are some companies out there, such as Sun Life of Canada, etc., who provide policies which are without any medical requirements, and you can get a level of cover. But frankly speaking, a lot of them will only insure you for 10, 20, 30,000 pounds, and the premiums prorated are quite expensive from that point of view, although there is no medical underwriting. So, certainly worth checking it out. But I think the biggest question you need to ask is why someone in their 80s wouldn't need cover. And once we know that, then obviously it'd be easier to give you proper advice in terms of whether it makes sense to even have that cover in the first place.
Yeah.
The question: whole of life is the only policy which will pay indefinitely, pay definitely. All other policies don't pay if you live beyond the policy term. That's correct. Yeah, so like we said earlier, term assurance is something you insure for 25 years. If unfortunately something happens to you within those 25 years, then the policy pays out. And if nothing happens, like car insurance, you carry on paying the premiums. After 25 years, the policy expires, and therefore you have no cover left. Whereas with whole of life, as I mentioned earlier, as long as you keep paying the premiums, whatever they are, then at some point in time, we're all unfortunately going to pass away, and that policy will pay out. So just to clarify that, in case there was any confusion.
Yeah, I think they just wanted to maybe add one or two things. Whole of life, if we're looking at types of cover, whole of life will be more expensive. Decreasing term would be the cheapest, because decreasing term is designed to cover essentially a mortgage, because as time goes on, your mortgage debt will decrease, and so will your cover. So that's your cheapest form of cover. And term, depending on varying length, you could have it for 5 years to age 90, whatever that is. And I think 90 is pretty good age to have up to that. And hopefully by that time you haven't got any liability. Whole of life is predominantly, I guess, we look at it for inheritance tax purposes.
I think also, just to add to that point, Paresh, typically, if we look at the difference in premiums between term assurance and whole of life, then whole of life can be 2 to 3 times more expensive than term assurance. But obviously they do different things, so you can't really take one for the other reason. So, just to be mindful that, it's whole of life. So it is going to pay out one day, and therefore premiums will be more expensive.
Any views on reviewable or guaranteed premiums?
Yeah, so reviewable premiums are great if you have a budget and you want to take out the cover, I suppose. So, they're cheaper to start with, but be mindful that over time, as I mentioned earlier, the premiums will increase over time and come to a point where possibly it will be more expensive. We traditionally tend to offer guaranteed premium for that reason alone, that sometimes it may be more expensive to start with, but as I say, over time, it works out at a sort of cheaper option, if you like, or more value for money option, I should say, overall. So I think it's a better form of cover.
Yeah, I agree with you, because at least it's a known cost. What tends to happen is that, in my experience, when people see premiums going up, they will think, okay, well, I can't afford it, I'm going to cancel it. Whereas it's a known cost. If it's £50 a month, you know you're going to be paying that, and the premiums aren't going to increase. So you will keep that, more likely to keep that policy running. And one other thing is that if you've taken out a policy for a specific purpose, i.e. a loan, and that's been paid off, or you won the lottery and you don't need the life assurance anymore, you can cancel. There are no penalties in cancelling the policy. There is no cash value on most of the plans, apart from whole of life in some instances. But so, there is no compulsion to keep the life assurance going if you don't need it. You cancel it. So just like life, car insurance, you bought it today, you sold the car tomorrow, you don't need life, car insurance anymore. You cancel that car insurance. So unfortunately, you don't get any refund.
There's another question here from Hava. Is COVID covered as cause of death?
Yes, I mean, I think if an insurer takes you on board, they take you on board based on your disclosed medical disclosure, and as a result, if you pass away, yeah, it pays out. It has to pay out.
So I think there's worth a clarification here, and that is that all insurances are based on your current health situation when you take the insurance out. So if you're 30 years old and you take out insurance and you've got no medical conditions, then the cover will be based on that. Even if your medical conditions, as time goes on, you start having more medical conditions, the cover is still in place because you're not under any obligation to inform the insurance company of any changes in your health conditions thereafter. So again, comes back to the same point that insurance taken out whilst you have no health issues is always cheaper than the ones that you do. And if you've taken a policy out previously and unfortunately passed away from COVID, then there shouldn't be any reason why an insurer won't take it out, won't pay out rather.
I would have thought it would be very difficult for the insurer not to pay out if they've taken you on, carried out all their medical checks and so forth. I think we will close off in a minute, but I think last time we had a few questions that came up afterwards and we weren't able to answer them. So just give everybody a couple of minutes. If you want to have any questions, please put them on there and we'll take them. And meanwhile, we'll cover next month's.
Yeah, so I was just going to say, I think it'd be a good time to just mention the next session, which is due for the 19th of August. It's all about making the most of your personal allowances. So what we're going to cover in that is a lot of people think personal allowances, what are you talking about? And are there so many? But I will tell you there are plenty of personal allowances, and most of them are allowances which either you make use of or lose. So for example, there's a pension personal allowance, there's an interest personal allowance on savings, there's a capital gains tax personal allowance, there's ISAs, junior ISAs allowances.
Vinay, don't give everything away.
No, so just to give you the bullet points of what we'll be covering.
Yeah, otherwise they won't join us next week. So, okay, I think that if there's no more questions, we'll take your leave. And thank you all for joining us. Have a good evening. See you next month.
Thank you very much, everyone. Bye-bye.